Hello, my name is Rohan Williamson. I'm a professor here at Georgetown. I'll introduce our keynote for today. It's the Honorable Terrence A. Duffy, who served as Executive Chairman and President of the CME Group since 2012. He's responsible for overseeing the world's leading and most diverse derivatives marketplace. In 2003, the CME Group handled more than 3 billion futures and options contracts worth approximately 1 quadrillion in notional value. He's been a member of the CME since 1981 and a member of the board since 1995. He's held several positions over this time, including chairman of the board of the CME Group and executive chairman and chairman of CME Holdings. He is also the former president of TDA Trading Incorporation. Mr. Duffy was appointed by President Bush and confirmed by the U.S. Senate in 2003 as a member of the Federal Retirement Thrift Investment Board, a position he held until 2013. He currently serves as co-chair of the Mayo Clinic Greater Chicago Leadership Council and also the vice chairman of the CME Group Foundation and president of the CME Group Community Foundation. Duffy is a member of the Economic Club of Chicago, the Executives Club of Chicago, and the President's Circle of the Chicago Council on Global Affairs. Since 2003, he has been recognized as one of the top 100 Irish business leaders by Irish America magazine. He attended the University of Wisconsin-Whitewater, and in 2007, received a Doctor of Humane Letters from DePaul University. Ladies and gentlemen, Terrence A. Duffy.
Thank you, Professor. I appreciate it very much. Professor Agarwal, thank you very much for inviting me here to be here today. I was here just a couple years ago, and I talked a little bit about financial markets, and we're still dealing with the lack of confidence in the overall marketplace, and I think it's important that we address a lot of those issues today. So my remarks today will be centered on correcting the record and helping to preserve confidence in those markets. Specifically, I want to talk about the role technology plays in upholding investor trust in the financial sector. I think it's fair to say that the public debate today has included a great deal of misinformation, especially regarding the integrity of our equity markets, which are critical to capital formation, not only from the American marketplace, but the global economy as well. In most industries, advances in technology are applauded, and improvements in speed, efficiency, and ease are eagerly anticipated. If you just take a look at the hype around the iPhone 6, or take a look at the new Fidelity commercial where they're promoting speed of execution, yet over the past couple of years, somewhere along the information highway, the reputation of Wall Street's use of technology has definitely skidded right into the ditch. Clearly, there have been bumps along the road with Facebook's IPO, Knight Capital software glitch, and the flash crash of 2010. But based on newspaper headlines and the tone of the public dialogue, you might think that the financial markets are the Wild West and the traders are definitely the outlaws. All this distortion, however, has real consequences. It does a tremendous disservice not only to the trading and investing communities, but also to the marketplace overall, and most important, to the investing public anywhere. It's kept investors on the sidelines. As a result of the majority of American people missed out on one of the biggest rallies in the equity market in recent history. I was listening to the panel prior to me going up here, and they were talking about the participation in the marketplace, where they are at levels today. I'll give you a statistic to kind of maybe give you a different measurement. More people own cats in the United States than they do stock. Think about that. So when people are concerned about how they're going to invest, you have to realize that IBM's not the bad guy here. Procter & Gamble is not the bad guy here. Apple is not the bad guy here. We have to look at what is really important here and what the structure, what people want to invest in, and that's in those companies. They gave you a lot of reasons why things can get better and the transactions will get different. But that's something that I really want to talk about, is you have to have the confidence in the marketplace, and we're going to get to that in just a moment. But there's also another real perplexing set of events that's going on right now. And I'm a geopolitical fanatic only because I can't help it. And when you look at the prices of today's products in lieu of what's going on, they are showing beheadings of innocent individuals. We are showing countries being invaded by other countries, and people are afraid to put sanctions to that other country. We are seeing a whole host of different issues that would have made people's teeth rattle just 10 years ago in the markets. To give you an example, I can remember trading in 1989 when Chernobyl happened. And just because a nuclear reactor had a problem over in Russia, everybody in the U.S. felt that we were going to feed all of Eastern Europe for the rest of its lifetime. So in return, traders had a whole different mindset of what they thought prices would be worth, not during the Chernobyl incident, but for the next 10 years. Today, we are seeing things that are being put on page 1, 2, 3, 4, 10 of the business section. Nobody cares. That's concerning to me from a social aspect, but from a market aspect, because there is going to be a day of reckoning. People are going to wake up one day and say, you know, this has more consequences than I originally thought, and what are we going to do about it? So I look at what is real and what is not real. So these prices that we're looking at today with low volatility in lieu of all these geopolitical events, what's going to happen? So I'll tell you what's going on in CME right now. We have 108 million contracts open. So you might think, what does that mean? It means $50 trillion of open positions on the exchange of CME. That is the largest amount of open interest we've ever had in the history of the CME. And what's going on? A lot geopolitically, but nothing as far as price movement changes, zero volatility. So it's a strange phenomenon that we're seeing that we've never seen before. We have $20 trillion of interest rate swaps open on CME Group today. A year and a half ago, we had zero. So people that are looking at page 6, page 5, page 4, they definitely have a different perspective of what prices are going to do. Otherwise, we would not see the people hedging the way they're hedging today. Interest rates being at these all-time lows, they are hedging these interest rates. They're still critically important. Food, all the different products that CME trades, we're seeing incredible participation. So let me transition out of that and talk a little bit about some of the perception that's, they talked about with the voice high-frequency trading. We know when an author went as far to say that the markets are rigged, blaming high-frequency traders for that. And we can all remember when 60 Minutes came on, and Michael Lewis's first 3 words were, the U.S. equity markets are rigged. $23 trillion U.S. equity markets rigged. So when we think about the U.S. equity markets, what does it do for people? It gives people an opportunity to create an idea, to create a business, and then they need to get some kind of liquidity to expand those businesses. What does that do? That creates jobs. That's how the equation works. There's so much involved in that. $23 trillion market is now officially rigged. A bit of a stretch. Rigged to the upside, I guess a lot of people would like that. We don't see too many things that are rigged to the benefit of everybody else if they're in the market. It's not rigged. HFT has become an extremely polarizing issue. It serves as a good discussion point in the role technology plays in our financial markets. What Michael Lewis is saying is, on 60 Minutes, he said that when an order enters Lower Manhattan and goes to BATS, that everybody can now wait at BATS, see the order, assume the order is going to go somewhere else, and they're going to race to the other 17 other exchanges or 16 other exchanges or dark pools and get in front of that order. What he doesn't say is the broker doesn't have to completely execute that order. He could pull that order. There's a lot of different things they can do. HFTs can try to go around it, but in all honesty, it doesn't mean anything. So what's really important is what Michael Lewis needed to say was, if there is illegal front-running of anybody, that's completely unacceptable in the financial markets. And that's the way we need to get people coming out and talking more about the integrity of the marketplace, transparency in the marketplace, to show that these things cannot happen. That book was extremely damaging, and I think it was a little bit reckless. But there's some things in there that are true. There's some market structure issues in there that are true. You heard it from the panel before I came up here. So there are 2 competing viewpoints on HFT that directly relate to the larger market structure we're having today. Some of it is a destabilizing force that provides an unfair advantage to large institutions over retail investors. It's not what I heard up here a minute ago. Others say high-frequency trading dramatically makes the market more efficient as it relates to the execution. I heard a little bit of that. In fact, the fact is, whether it's high-frequency trading or other form of participation, it's important to make sure that our capital markets operate efficiently. the way that everyone has access to the correct pricing. And when I talk about pricing, I think that transparency is going to be the future of any market that we trade. People today are sophisticated. We talk about technology. Well, the end user has technology also. So we want to talk about institutional trades. Guess where that institutional money came from? It came from individuals that combined together to make it into institutional money. So the bottom line is we are watching. And we're going to demand more of it. And we should demand more of it. Whether the price is $1.10 or $1.15 is irrelevant. As long as I can see that $1.10 and $1.15 and know that's what the market was and that's what I'm entitled to. That's what's important here. And that's the only way you're going to restore confidence and get rid of the cats. That is truly the way I look at these markets. People need to be involved in these marketplaces. And they're not going to until they can feel comfortable and confident that they are not being front-run in the marketplace. And I'm not suggesting they are. The book is suggesting they are in a very obscure way. The market, the way it's set up today, is suggesting it is. Fragmentation is suggesting it is. Dark pools, lit versus not lit, is suggesting it is. 40% of the equity market being dark is suggesting it is. These are all things that need to be addressed. But on speaking as my role, I can tell you when bad behavior happens in our markets, we take aggressive enforcement action. We police high-frequency traders as well as all market participants, no matter who they are and how much they trade. We have a full and complete audit trail that allows us to track the market activity in real time. In fact, following the flash crash of 2010, we were able to provide our regulator with a record of each and every trade that happened on CME on that day. Meanwhile, the securities exchanges, as we heard earlier, are still trying to get a consolidated audit trail together to get information like that. I testified in Congress right after the flash crash, and I got to bring something which I thought was really interesting. I brought charts, which I never do. I hate visual aids. I hate even looking at remarks. I like talking. So I brought all these charts, and I felt like a weatherman because I had a pointer, and I was doing this, and I was doing that. And I said, okay, we're going to blame the E-mini S&P 500 for the flash crash of 2010. Let me explain to you how that is completely impossible. Let's go through the markets. Where did the E-mini go that day? When did the supposed large asset manager enter his order? How did he enter it? And let me show you how. He didn't fire it in there and just put a nuke in there and bomb the equity markets. We have all different types of functionality in our marketplace to prevent that. Actually, the large asset manager that was in question sold on the way back up. So I need somebody in that hearing room that's blaming the CME or the futures markets for causing a flash crash to explain to me how I put Accenture to a penny. I don't trade Accenture. Market structure put Accenture to a penny. How did it take other stocks to these prices that were ridiculous? Stub quoting put Accenture there. Not CME Group, not the futures market. The fragmentation, the structure of the equities market put it there. So I walked out feeling really good about my testimony, and of course you get criticized. Damn futures traders. I mean, that's all you're, damn futures traders. Got to blame somebody, those guys who did it. And that's okay, because I don't mind being called the damn futures traders when I have the facts, when I have the market data, and my people on the other side sitting next to me have no data, no facts. How can they say that they did not have a problem in their world? So CME, like other exchanges, is the frontline regulator to our markets. We are the DSRO, which is the designated self-regulatory organization that we are. To put it simply, if we don't have integrity in our markets, we don't have a business. Therefore, we are committed to the highest level of compliance. In this effort, we utilize our innovations to prevent manipulation of disruptive trading activity. Just 2 weeks ago, we amended an existing rule to further clarify that we deem as disruptive trading activity. You know, this was kind of one of those damned if you do, damned if you don't moments, because you're going to put out a new rule that talks about disruptive trading. Well, here's just another situation where the world says, Jesus Christ, didn't you have a rule about disruptive trading? Yeah, we have a rule about disruptive trading, but they're broad, so it's a kind of a catch-all situation. So, you know, when someone says they're doing something that's not nefarious in the marketplace, I can show you a pattern, and I would say, well, I got to be honest with you. I think you are doing something nefarious in the marketplace because you lined up a bunch of sells all day long, and all you want to do is try to buy. You had no intention of selling. So eventually we have to look at what is deemed as disruptive trading practices. So we took this new rule and put it into place, and we put not some teeth into it, there's already teeth into the rule. What we did was we started to explain to people, we're not going to tolerate this. The market's not going to tolerate it. So we need to have credibility. I spent 35 years of my life at this institution, and if people think they're going to make a quick flip trading one of my products, it's just not going to happen. You know, you need to get into the marketplace and do risk transfer. That's what futures are all about. We create liquidity so farmers can lay off their risk in agriculture. Bankers can lay it off for their interest rates. That's exactly what we're trying to do. But I'm not going to allow somebody to come in there and take advantage of other participants and not pay attention to the rules. So that's why we put in that new rule. And I think we've given more confidence to the marketplace. We set controls that give thresholds to the customers on each of their credit limits. We have automated controls and reject erroneous prices for sized orders, whether the result are someone's error or a malfunctioning algorithm. Also, we have stop logic functionality, which prevents extreme price movements. This is really interesting. So when I'm sitting in Congress back in 2010, I'm talking about stop logic functionality. Now, one of the securities exchanges had it. I walked Congress through what stop logic functionality does, which basically means when a market goes down precipitously, if it cannot find liquidity, it stops everything. It gives a timeout. It replenishes liquidity. We'll trade at a different price. If it can't find liquidity, it'll stop again, try to find liquidity, and so on. And it gets to a certain point, it's done. We're closed. It's just going to shut it down for a while. And then obviously the speed bumps kick in. So I remember one of the members of the Senate asked one of my security colleagues, do you have that functionality? And they said, no, we don't. So I said, I'll give it to them. I said, well, absolutely give it to them, free. They can have it. We'll show them how to implement it into their systems, and that will prevent, hopefully, some of the stub coding problems in Accenture going to a penny. Nobody took me up on my offer of taking stop logic functionality at the zero price or velocity logic functionality, which shows if markets are going too fast with a wave of volume, we can also slow those down. These are things that we put in place to give confidence to the marketplace. Unfortunately, in a marketplace, we all get painted with the same brush, no matter if we're a futures exchange, or whether it's a securities exchange, or a trader, or anybody else. That's just how it works, and I understand that, so I don't get upset by it. I try to explain the differences in different marketplaces that we have. Do we have some flaws? Sure, everybody's got flaws. But at the same time, when you look at the vertical silos that the CME Group operates under, we know exactly where every trade is at all times. In a fragmented market, it's a little difficult to know where those trades are going. Also, we work in coordination with the securities exchanges, as you know, as it relates to circuit breakers. So we are in complete coordination with all securities exchanges for our compliance. It's also important, this discussion, to stress the structural issues at work here. The majority of the concerns about high-frequency trading are specific to equity markets. Many simply don't apply to futures markets because, as what I said, the silo structure. When you put an order in at CME Group, no one knows you put that order in but you until it hits our proprietary system. It's not a web-based system, it's a proprietary system. So no one can see it but you. I think that's a very important point because when you do put an order in under Reg NMS, as you all know, you heard it in the last panel, it's got to go to the best bid and offer. And I think the intentions of Reg NMS made a tremendous amount of sense in 05 and 06. Who in the hell knew that we were going to be trading at the speeds we're trading at in 2014? It needs to be looked at again. At the same time, however, we also, the markets had increased fragmentation in the securities world. And I don't want to sit here and bash the securities world because I don't think that's fair. But they do need to go ahead and figure out different ways to bring people back into that marketplace. And it's not applying my market structure. That's not what I'm saying. I'm saying they just need to address it. And you can have a panel up here and we could talk about it, but things need to change and they need to change quickly. You know, people talk about Wall Street all the time and Wall Street versus Main Street. You know, I am absolutely convinced there is no Main Street without Wall Street. And I don't consider Wall Street a small street in New York where a bunch of traders trade on New York Stock Exchange and they set the prices for the world. I consider Wall Street anywhere in the United States of America that has capital markets that help and create jobs. So I do believe that we need to restore that, and maybe the best place to restore it is to get in the middle of the country and try to push the confidence from Iowa to New York, from Nebraska to LA instead of from New York down someone's throat in Iowa or Nebraska. So I've been trying to spend a lot of my time in the middle of the country talking with different participants, whether it's about market structure or whether it's about derivatives, and let them know that there's got to be confidence in this marketplace. So I think it's key. I think it's essential. I have 2 young kids. I have 11-year-old twin boys, and I'm 56. I want them to have a great future in this country. I'm supportive of legislation. I think Dodd-Frank was essential. I said before, if we didn't have it, we may have knocked ourselves right into the Stone Age. Whether all of it is good is something else. That's always the case, though, with legislation. The Congress votes on it, turn it over to regulators, you guys write the laws, and hopefully it mimics what we all voted on. Sometimes that doesn't happen so much. But that's critically important that we have adult supervision in the marketplace today. And that will, again, help create more confidence. So even though a lot of you in this audience are from outside agencies, I like to take, and some of the young people aren't here from the classes, but I think students are still wondering, has Wall Street lost its purpose? You have people graduating from universities such as this fine institution and on coast to coast that normally would go right to New York or Chicago or another place working in financial services. They're not doing that anymore. They're going to Silicon Valley. The numbers are staggering where they're going. And we have to have young people get back into financial services. I think it's critically important for the history and future of this country. If you don't have a strong financial services system in the United States of America, that means that we have to import something that looks like a financial services system. With that, you get to have the ability to accept the price for those financial services that are set in other places around the world, and you don't get to participate. The money that comes into the United States of America because of the financial services system benefits us all, whether you're in this industry or not. Real estate's a great example. People from Eastern Europe and other parts of Europe, they invest them up and down the Florida coast because they want to get money out of different parts of the world. They'll buy real estate at any price. And that's why we've seen a lot of turnover into real estate down there. So I do think it's important that we have more people really being focused on financial services. One of the things I also like to talk about is agriculture. So today, the world sugar market, maybe this isn't exciting, but what's interesting about it is we set the price in the United States for the world sugar market. We don't produce the world sugar market, but we set the price for it. That is a huge benefit for us to do that. We set the prices for all the food that we eat. That's a huge benefit. Today, in Iowa, you can get a bushel of corn for $3.50 a bushel, put $1.50 of transportation cost on it, ship it to China for $5 all in. You know what they're paying for a bushel of corn in China in Dalian? $10 a bushel. Why won't they take it? Well, there's all kinds of reasons why the Chinese will not accept our $5 corn. But the point is, we're setting the price, which is critically important. Because again, if we don't set the price for these products, we have to accept what the price is that someone else has decided we're going to pay. That's a terrible situation for the United States of America to be in. We should definitely look at our technology and try to expand it further and further. I think that these are things that we need to do. And then for the young people of Georgetown, I always like to say a couple things. When you look at your future, and even some of us that are a little bit older can look at this, we can't be so nearsighted about what we need to achieve. So many people today need instant gratification, and we've all become victim to it. And I'm not saying it's bad, good or bad or indifferent. But if we're going to have a better world, we need to have young people that are being taught at this university to take a look at the horizon of what they think is going to be a good job. So if their classmate gets offered a job for $70,000 and they get offered a job for $50,000, who's the better off of the two? Well, simple math says it's the $70,000 participant. Let's see what happens 10 years down the road when somebody took $50,000 on day one. That $50,000 a job might be $10 million a year. You don't know. My first job at CME, I made $54 a week. I came from a very blue-collar, middle-class family from the south side of Chicago. My mom and dad mortgaged their family house to get me in business when I was 22 years old, and I lost it in a week. And then I lost another $100,000 on top of that. So you can imagine being 22 years old. Your mom and dad signed their house over. Your siblings are going to be on the street. And by the way, my dad didn't know he signed it. My mom signed it for him. So I had a great gentleman that was willing to invest in me, not by giving me money, but by giving me his reputation and guarantee my folks that they wouldn't lose the house. I worked 4 jobs to pay that off. And what did that do? It taught me one thing. It taught me discipline. And I think discipline is critical to everything we do in life. And I try to tell that to young people all the time. And I've decided, as I've been speaking to some young people, you know, maybe I'm missing it. Maybe I need to talk to more people my own age and talk about discipline. Because I think we need to have discipline. So I was doing a show on CNBC on Friday, and they're talking about trades. And one of the hardest things to do is to sell something at one price and buy it back at a higher price the next day. Well, your discipline said you're going to get out at this price, but you know, you can say to yourself, I'm wrong. I'm going to get back in because that's the right thing to do. That's a good discipline. So I'm a big believer, since I lost that $150,000 back in 1982, that I've always figured out I need to have an exit strategy before I ever have an entry point. In anything you do in life, if you can figure out the exit point prior to entering into it, you'll be much better off. And it works 9 out of 10 times when you really analyze it. So whether you're trading the markets, whether you're just looking at products and services, if you can just look at an exit point for your own lives, I think you'll be much better off as you go forward. So that's something I try to tell the young people. This is a great country. The opportunity is amazing. A lot of people in this room look a lot like me, except for a few young folks. And I know what 3 things are going to happen to us. We're going to become disabled, we're going to die, or we're going to retire. There's going to be a lot of opportunity in the next 20 years as these baby boomers go through one of those 3 things. And that's not a bad thing. That's actually a very positive thing, because there's been so much negativity thrown at the market as far as young people are concerned. What are they going to do? So the graduates of Georgetown in 08 and 09 and 10, I'm sure were very frightened the day they walked out of this university, thinking, what am I going to do? I think you have the brightest future I've ever seen in a long time because of certain things, the way they're setting up. So embrace technology, have discipline, have an exit strategy in your everyday lives and in your businesses, and I think you'll be much happier all in all, and I think you'll be much more successful. And I thank you very much for inviting me here this afternoon. Thank you.
Okay, thank you, Mr. Duffy. We're going to open the floor up now for a few questions. Do we have any questions for our Terrence Duffy here?
So my question actually goes to market confidence, but it also goes to the Dodd-Frank and clearing. So the CME is now responsible for clearing all those contracts at open interest. And so when you talk about how clearing works and how the customers are protected there, and whether there's enough capital.
You know, as you may have seen something, I think a week ago Friday, by J.P. Morgan, saying we've shifted all the risk from the bank's balance sheets, to what Carolyn's referring to the clearinghouses today. Is that a good idea? And if it's a good idea, should we not insist upon the clearinghouses participating in a greater part of the overall default and contributing more money to the system? So the difference is, first of all, when Dodd-Frank came out, I lobbied against certain portions of Dodd-Frank, and one of them on the clearing aspect was we had to have the ability to reject the swap. That's first and foremost. So on the clearing of futures, they're fairly vanilla. They're standardized. There's a lot of people that participate in the liquidity is deep. But on swaps, it's a bit different. So we wanted to have the ability to reject the swap before it came in there. So that was part of the law. Secondly, we do daily mark-to-markets on all of our positions, including our swaps. Our swaps versus futures, as you know, Carolyn, are margin for 1 day for futures, 5 days for swaps. So there's a big difference there. The real benefit for CME is we're not doing a lot of credit default swaps, as you know. we're doing something that we're very good at, which is interest rate swaps, because we can offset them against the largest interest rate portfolio in the world, which is our Treasury complex and our Eurodollar complex. So we've saved clients billions of dollars in capital efficiencies by nobody needs two swaps versus futures together. So I think the way we do the business today, and I would not want to put a comment to my bank friends that they weren't doing it properly, but there's a lot of trades that happened with big bank clients that say he's good for the money and not to worry about it. Well, all of a sudden AIG wasn't good for the money one day. What happened? Well, we all know what happened. So I think just the whole structure and the way we're doing the market, we don't have $671 trillion of swaps at the CME. As I referenced earlier, we have $20 trillion of interest rate swaps, and that offsets against our futures portfolio. So I think because not only creating efficiencies, but it makes this system a bit safer in the way we manage that. So Carolyn, that's kind of how I look at the overall clearing of the swaps versus the futures part. And I'm not sure if that answered your question, but I hope it did. Yes, sir.
Yeah, I'm Pete Kyle from the University of Maryland. I have a question about something people in this room may not know about, but is, I think, potentially very important. So a couple of years ago, the chief economist of the CFTC wrote a paper documenting the profits that high-frequency traders make when they have different types of counterparties, and showed that they were maybe 1 basis point with retail investors, but a fraction of a basis point with institutional investors. And in response to that, the CME wrote a letter to the CFTC claiming that they were inappropriately using confidential data to conduct research, and the result was that the research infrastructure at the CFTC was gutted for more than a year, and their inspector general said that the CFTC was violating their legal obligation to inform the public about the way markets work. So my question is and it affected some papers I was working on too. My question is, given the lack of confidence that small investors have in the market, how is writing a letter like that going to be helpful?
Well, first of all, you got to remember everybody that's a client of CME, whether it's a bank, whether it's a proprietary trader, whether it's a farmer hedging his crop, or whatever asset class they're trading, those are clients of ours, and we speak on their behalf quite a bit. The data that you're referring to was proprietary data that people put millions and millions of dollars into to develop these different types of trading systems, whether they don't necessarily have to be high frequency or faster than the next guy. They could be algorithms and all different types of complicated methodology about if this happens, let's do this, and if that happens, let's do that. So I spend millions of dollars, not me, but my customers do, and all of a sudden a government regulator decides that he'll release that information to anybody so they can go ahead and copy that, and they didn't have to pay a thing for it. Well, that to me doesn't necessarily the way it's supposed to work. And I think that's what you're referring to, is that particular situation. And when you look at high-frequency revenues, I think this is even more important than that right now, because that's kind of yesterday's newspaper. But I will tell you that the revenues of HFT, it went from $5 billion in 2010 to a little under $1 billion in 2013, 2014. So the revenues have gone down dramatically, and the marketplace has become much more efficient, and that's just the way it works. But in all honesty, they weren't HFT algorithms. These were different strategy algorithms that they released that information. That's my understanding of it. Yes, ma'am.
Do you think that in the new world of cleared swaps, where the buy side is pushing up collateral to the FCMs and to the CME, that there's actually introduced counterparty exposure for the buy side? In the past, we used to collect collateral. Now we're pledging it, and I'd like you to comment on what happened with like Peregrine or MF Global, and how do you feel about full segregation of collateral?
That's a good question. This is not something that we asked for. This is obviously the way the structure unfolded, and more capital came to the CME because of Dodd-Frank. As it relates to Peregrine or MF Global, when someone's hell-bent on deceiving people, they're hell-bent on deceiving people. I mean, I don't know how else to say it. I mean, when a guy steals $200 million from a small firm over a period of 20 years, it absolutely amazes me. I was talking to one of my colleagues on the way out, and you think, how in the world could something like that not be discovered? You can see where 200 million could get lost in a very large institution for a while, but not 200 million in a very small bank. So falsifying records, doing things with that. Obviously, the guy is in jail and has admitted to his guilt. The MF Global situation is a bit different. As you know, Governor Corzine was very big into the sovereign debt markets, and it appears that he was using customer segregated funds to, which is against the law, to margin his sovereign debt positions. Falsified records were submitted to CME. We submitted them to the Department of Justice and the regulators, and we'll see what happens with that. The good news is, and if there's any good news on MF Global, is 100% of the money has been recaptured for the 4D clients, which are the U.S. clients, and I believe most of it's been captured for the 30.7 clients, which are U.S. clients trading on a foreign exchange. I think where some of the money's still missing is on the broker-dealer side of the business, so that's not my world. So I guess the comment would be, that's the way the law is structured, and we put new things in place to make certain. There's about 5 or 6 different things. We were very proactive about putting new safeguards into place to prevent the Peregrines or the MF Globals of the world. But I got to be honest with you. You could put a cop on every street and somebody still tries to commit a crime. It just amazes to me, and that's kind of what the point of my talk was earlier. I think the moral compass has been so lost. So hopefully that will come back, and some of the structures that we put in place, so some of the technology will make sure that the buy-side's money is completely safe as it sits in the clearinghouse. But you're absolutely right. There's more money sitting in that clearinghouse. But I will say this to you. When MF Global went down, they had $5 billion of customer funds. We were holding $2.2 billion in our clearinghouse. When MF Global filed for bankruptcy that following Tuesday, I still had $2.2 billion. So they couldn't get the money that was at the clearinghouse. They got the money that was under their control. That's the same situation you're in today. As far as individual seg goes, I don't have a problem with individual seg, but there's some legal boundaries here in the United States that make it very difficult to have individual seg. It's going to be an option, as you know, offered up in Europe, individual segregation. I think the acceptance will be to see what's going to be the cost of a pure individual seg, and that's when we're going to see how many people take it up. So I'm hoping the system is, I feel confident the system is safe, and the reason I say that is because when the bad situation happened, the money I had, I still had.
Terry, thank you very much. Okay, that was the last question. And got a little gift for you here. Thank you so much for a wonderful discussion.
Thank you.
And we look forward to having you back here at Georgetown. Now, a couple of things here. We will be having lunch at the Levy Center. There are individuals outside that will direct you to the Levy Center, and that's going to be about an hour or so. Then we'll reconvene over here for the afternoon session. Thank you very much, and enjoy your lunch.